So thank you very much, Professor Vernon L. Thank you for your excellent talk about the price mechanisms. And then you started from the personal motivation in market, and then you extended to the definition and to defining mechanisms of the price mechanisms based upon supply and demand and different information and so on. That's very, very interesting talk about the origin of economics. So that's very interesting. Here I'd like to add two comments to your talk about the price mechanisms. One is about the role that the monetary volumes could play to influence the price level. The second is the decoupling decoupling of the virtual economy from the real economy. That has also some impact on the price level. So first comment is about the monetary volumes. Since the collapse of Bretton Woods system, new elements have been introduced into the market that have a tremendous impact on the price definition level. First of all, as the money, the currency or the liquidity is totally free without control of the gold reserves. So the monetary volumes depend on central banks' actions. So when the central bank decides to pour in more liquidities, the currency, the liquidity may have a tremendous impact on the price level. Take, for example, the oil prices. In the 1970s, because of the then Secretary of State of the United States, Henry Kissinger's efforts, he made he contributed to definition of the oil prices only by the US dollars. So the US dollars has become the sole pricing currency of the oil future. Then the oil prices is completely determined by the dollars available in the market. When the Federal Reserve, when the US Central Bank released a lot of liquidity, to a lot of US dollars into the market, the dollar tend to be weakened, and then the oil prices tend to be rising. So there is a reverse interaction between the quantity of US dollars in the market and the prices of oil. That's the first comments about the relationship between the monetary quantity or the monetary volumes and the prices fluctuation. The second comment is about the decoupling of virtual economy from the real economy. That have also a tremendous impact on the price level. Since 1980s, the Western world, especially the United States, has engaged a deregulation act, a deregulation of financial markets that released a lot of financial derivative products in the market. And more financial derivatives have been added to a power, to the currency power. So that have a tremendous impact also on the price level. The positive aspect of the financial deregulation is that created more and more financial assets that absorbed to some extent the liquidity or excessive liquidity that the Federal Reserve is releasing. So this development of financial derivatives contributed to somehow to reducing the price rising pressure especially in the United States. But because otherwise, if there is so many financial assets that absorb the excessive liquidity, the excessive liquidity could lead to a hyperinflation, so a soaring of the prices. But the disadvantage of this development of financial derivatives, that the prices is more and more deviated from the real demand of the market. Look at examples. The future market demand is much more than the real market demand. Take, for example, the oil futures. Currently, we have more than 380 billion barrels oil futures exchange in the market annually, while the real demand, the real consumption of oil is something like 36 billion barrels every year. In other words, the virtual economy, the oil future trading is more than 10 times that of the real demand. If you look at its oil futures market, more than 70% of the market dealing was conducted by financial institutions. They are not end user of the oil. They are not the end user of the oil. They only trade oil future for financial profits. So that's but to some extent, the oil futures prices have a serious impact on the oil prices. If you, as the end user, as a real user of oil, if you wanted to buy oil, you have to buy oil in the future market. So the oil future market has a real serious impact on the real oil prices. So that's something, while the real oil prices have a tremendous impact on the general prices level, because we use oil in every sectors, in petrochemical, in fossil fuel, so for running cars, for running ships, for all these things, and also oil has a tremendous impact on a lot of our daily life. So I reached to my conclusion. The conclusion is a paradox in today's economy. The paradox is in today's economy that in economics, we know that the best way is to invest less but produce more. Then you have more profits by the producing process. So that's economic. That's economic because you can put less and you produce more. It's economic. That because it's advantages for the whole economy if you can put less and produce more. While with the development of the financial industry, we need to pour more and more money, while the production is not proportionally as well as the money pouring into the market. So we have, unless we may observe there is more and more financial assets, so-called financial assets, but the real profit is less and less important. We need more money pouring into the market to prompt up the market level and then to draw up a little profit coming from the financial assets. So in the end, the process of this industrial financial development is not that economic, contrary to the economic principle to put less and produce more. So Do we need more finance or do we need less finance? That's my question left to the audience. Thank you very much.
I'd like to make a comment. Professor Ding, I am very much in sympathy with the argument you're making. And I want to point out that regulation didn't begin in finance, deregulation didn't begin in finance. It began in the Carter administration, and it involved airlines, trucks, and railroads. That deregulation was seen as enormously successful. Those industries, all three, began to deliver products more in line with costs, and so that was seen. But notice, the products, these are transportation products. You don't buy them to resell them, you buy them to use them. You buy an airline ticket in order to go from point A to B, okay? And goods are trucked from point A to B to increase and changes their value, it raises their value. And those services are not retraded. And that's a very important difference. In fact, my co-author and I, we've been writing on that. And we're very sympathetic with what you're saying about finance. These goods are retraded. And retraded goods, the price can get disconnected from fundamental value, from use value. Think of it that way. You see, the price of a hamburger can't get disconnected from its use value because you can't resell it. Okay? The same thing for a hotel, or you rent a hotel room, you rent it to use it. So it's the value to the consumer that determines, you see, that value, and there is no conflict between resale value and use value because you can't resell them. And all of that changes, you see, is when you're talking about financial assets. And so I quite agree. I think the deregulation of financial assets brought quite unintended consequences based upon the good experience people had with transportation deregulation, not realizing that these are much different animals.
Yes, I agree with you.
Can I make a follow-up observation on what Vernon said? Actually, I meant to ask about this during discussion. But Vernon, during your talk, you talk about the multiple unit option. And just now in your response to, or your comment on Professor Ding, you talk about Carter's administration's deregulation of much of the transportation industry, especially the airline, in particular airline landing slots. I remember listening to you over lunch at Arizona when you were writing the paper with Steve Recenti. And I was really struck by, at least let me just compliment you on your creativity, because the idea of combinatorial goods or combinatorial auction was really quite insightful and eye-opener. Okay, so in your comment about the two Smith work, or maybe particularly the Wealth of Nations, were you tempted, or did it occur to you to ask, would combinatorial type of pricing arise in this kind of a spontaneous manner, as in the discussion of a price discovery?
Well, a demand for it might arise spontaneously, you see, but the supply, you see, that involves at minimum the tools of operations research, you see, that have been applied. In fact, I haven't followed combinatorial auctions in recent years, but I looked last year at what was going on, and I was astonished at how much that literature has developed, and the OR literature has really taken off on issues of combinatorial auctions, and there's been some real world applications. but it's hard to see how those applications could come about without some specific kind of public design models being used. Of course, we always thought they should be tested, and that's why we use the laboratory for that, because the stuff that survives out there in the world, you see, goes through some testing process like that. But what do you do with something as sophisticated as a combinatorial auction? We saw that we needed to use empirical methods for testing those where we could control the parameters that were involved.
Well, perhaps I can challenge you a little bit further, because the idea of market of late, in the last couple of decades, have evolved quite a bit towards non-price mediated exchanges, such as matching markets. So, it's a natural question to ask. Even in the Adam Smith era, people got married and got assigned to dorm rooms. Yeah. Do you have observations regarding that?
Well, I think these matching markets, it's incredible. You see, now we can now match buyers and sellers in real time and space. Okay, look at Uber, look at Lyft. The whole idea of a central dispatch for taxis is obsolete when you can match individual buyers to individual roving taxis. You see, it's amazing, and I think we're just at the beginning of that development, that breakthrough. And you see this, I think we realize what a really tremendous contribution that Ronald Coase made. And, as early as 1937, he asked a really interesting question. He says, why are there firms? Why don't people just contract with each other to deliver and supply whatever is needed? Well, he recognized that a hierarchical firm had a function depending upon, you see, the transactions costs of people dealing with each other directly. But that idea, you see, and it wasn't transactions costs, information costs were not part of the traditional way of modeling. There was marketing value that led to demand, and then there's production cost. And that was relatively unsophisticated compared with, you see, what the point that Coase was making. And this is actually what led him to propose that the auction spectrum or the frequency spectrum be auctioned, because he realized if you got the spectrum out there and let people trade, people would buy and sell and put those into packages that were more efficient than would otherwise occur. He saw that happening in the 1920s in the radio. See, radio licenses were issued to all who would apply in the 20s. And so you had all kinds of interference. You had firm A broadcasting and interfering with broadcasts from firm B. Well, he noticed that they were merging and separating and forming incentive compatible organizations. And they were controlling for that externality, you see, through negotiated schemes. And so he saw that as depending upon transactions costs, that was the kind of thing that you could expect to happen. And we live now in a world where those, it's incredible how those costs have dropped, and they are really important in a lot of industries.
Thank you.
Okay, since the time is limited, now we're getting to the Q&A session for the audience, and even since we're broadcasting this talk,
Oh, you are not going to have my follow up on Vernon's talk?
You can you squeeze it into 10 minutes because of the time limit?
Yeah, I can do that.
Of course, you can, please.
I need to share screen. Can you authorize me?
Yeah. Yeah.
Okay.
You can do that. Yeah.
Go ahead, Chew.
Hi. Okay. Jokingly speaking, this talk was prepared before I knew that you gave a talk. Anyway, in particular, of course, this is relating to your slides directly. So you observe that Adam Smith modeled price formation in spite of him having written the theory of moral sentiments, about other regarding behavior and how they can actually they are let's say they work in tandem, the two books. And in particular, we all benefited from your work, your pioneering experiments in 1962, testing the model of price discovery. So let me just mention that Milton Friedman seemed to be Smithian in terms of the wealth bit. So social responsibility is to make money, whereas Henry Ford, on the other hand, actually is more green. Okay, he's implying social responsibility. And then, nowadays, we can see that even in the world of financial investment, ESG, or socially responsible investment, has become an item. In particular, the idea of, virtue stock is now just in the air. And on the flip side, since stock has been around for a long time, and historically they tend to outperform the market, but people think that it's anomalous. But on the other hand, perhaps it's because people that investors do have a heart, as in theory of moral sentiment. So you need to entice them with excess return before they get involved. So this is, of course, a line that is linked to Smith, Hume, and also an early Chinese philosopher, Mencius. The idea that we have moral if we are not indifferent to the plight of others. And also, in that sense, moral can perhaps encompass the sentiment of beneficence, as you were mentioning just now. One thing that is kind of recent in the literature is this idea of karmic investment hypothesis. I guess we are all familiar with karma. So here is a line from this recent paper. Waiting for an important, uncontrollable outcome may lead people to do good deeds with the implicit expectation that the universe will return the favor. That is very karmic. I just will say that I will not present the utility theory or moral sentiments that we have developed for this purpose, except to note that our model of individual investor behavior encompasses three channels for moral stock preference: social preference itself, as discussed about the trust game; karma-based belief bias, as just discussed; and something called source preference that will become apparent, that I will elaborate a little bit more very soon. So here is the experimental test in investment setup. So literally, this is in the context of a sin stock. Notice that among the 10 options on the left consists in choosing whether to invest in a stock that has no pollution or a stock that has pollution. And starting with one, if you invest in the stock with pollution, you win 10 cents more. And all the way to the end, you win $1 more, which is 50% more than $2. So you always get $2 if you invest in a non-polluting stock. This is a stock that's created experimentally based on the trailing digit of the stock price, whether it's an odd number or an even number. So I guess we can imagine that odd and even are essentially even chance event, 50-50. But we are testing whether people would be uncomfortable or be averse to betting on odd even of a sin stock paying a little bit more than on a non-sin stock paying less. And then correspondingly, we can also do a virtue stock assessment. And here's the experimental result on eliciting sin stock aversion or virtue stock affinity. The red curve, I guess you can see that, but I'm going to. Okay. The rate curve tells us that at 10 cents premium all the way to $1 premium, there's a decreasing proportion of our subjects who still favor the non-sin stock. So they are giving up an extra up to 50% payoff increase. And correspondingly, for virtue stock, there's also a decreasing function. But notice that sin stock aversion is bigger. The elicited sin stock aversion premium is higher than the virtue stock aversion affinity premium. This was also reflected in Vernon's talk about the sense of the sense of loss aversion. In this case, it's a moral loss aversion. Somehow, we are more averse to being sinful, shall I say, than being moral. The main result of the paper are three. We do observe sin stock aversion and virtue stock affinity, with the effect of sin stock aversion being stronger. And the asymmetry I've just mentioned seems to suggest a form of moral loss aversion. Moreover, sin stock aversion and also virtue stock affinity is individually positively correlated with social preference, including altruistic giving and trust. And then finally, both kinds of moral stock preference are also correlated with belief bias in terms of karma. So my concluding slide is this. So we offer a utility theory of moral sentiments, which captures the three channels for moral stock preference. And we also experimentally validated the model in a lab setting. And then finally, we think that this is at least something that behavioral finance and green finance people might adopt to model investor behavior. Thank you.
Very interesting, too. You know, I manage a personal portfolio of biotechs. And biotechs involve a lot of issues similar to this because, you know, they're doing good by finding new forms of treatment of disease. It's mixed up with that also potentially, of course, being profitable. But I find myself attracted to certain of those stocks because of what looks to me like the tremendous moral value, you see, what's coming out of that. Mm-hmm. And I don't know that I'm sacrificing any money as a result of that because these stocks also can have really high market value because of the potential. Because we're talking about therapies for the generation of new cells in stroke victims, you see, where you don't try to repair damage, you just create a whole lot of new cells, you see, for the blood to flow through. and there's a lot of those, and a lot of eye diseases. And of course, at my age, I'm particularly aware that a lot of these diseases are common in my group. but it's exciting to see. And in fact, the vaccines for the coronavirus, people don't realize that a lot of these vaccines were already on the shelf with biotechs. I mean, they had already invested in the development of vaccines that were closely enough related to the coronavirus 19, you see, to be adaptable as a vaccine. So anyway, yes, very interesting.
Thank you.
Okay, thanks, Professor Cho. It's very, very interesting paper and research about moral low suburban. Now we can get into our Q&A session. For the audiences, for the people in the Zoom, you can raise your hand. We can pick you. You can directly ask questions, or you can type the chat box. Please. I think we have one question from Zhenhai. Please.
Hi.
Please. Yeah. Please, can you?
Zhenhai, you're muted. You should unmute.
Yeah, I'm.
You mute. Okay. Could you hear me?
Unmute.
Okay.
Yeah.
Could you hear me? Yeah. This is Zhenhai. I can confirm the Hainan Green Finance Research Institute in Beijing, and I'm a researcher and I focus on the sustainable development. And my question is about how to explain the disruptive innovation, the price, how to make price, such as the Tesla's electric vehicles for price in China market. About the EV, the market is very huge in the whole world, but especially in China. The Tesla's price is depend on the market development, such as the another branch, such as the local branch in China, provided a high price the product in China EV the market. Finally, the price is the market price is based on the high technologies, the high technologies, the high innovations, such as the Tesla's the EV's price. This is make price standards in China. If you explain the market price, how to based on how to expand based on the classical the economic the series the supply and the purchase. So I think is based on the price strategy is based on the Hungary the price strategies. But in other hand, we can expand based on the new classical the price the series to explain the I think is about the marginals utility. You know about the customers they enjoying to purchase the Tesla's the brand the EV, and then another price, another brand, and then another others brand EV brands in local China. But the reduced price in the mainland China the EV market, so they can control the high levels the products the price in the whole China of the EV market. So could you give me some advice how to explain about this is a phenomenon?
Well, I guess I'm not sure what the question is. I think, I mean, I didn't follow all of your, because I'm not familiar with all of these things you're mentioning. You see, but the basic principle in market pricing is based upon the notion that value is private and decentralized. It's not available in any concentrated form anywhere. And the natural way, see, Adam Smith had a natural way to think about how to measure this. And that is, what was the individual demander willing to pay, the maximum they were willing to pay. And so he thinks of buyers with limited information, but knowing their own, having a sense of what they're willing to pay, going to market and essentially bounding their own behavior. That is, I'm not going to pay more than a certain amount because I can't begin to be sure that I'm getting value in proportion to what I'm giving up. And the main thing that does to that buyer is prepare him then to search for a low price, to negotiate, to obtain somehow, you see, a low price. And when you end up, when you find out a price much below the most you were willing to pay, well, that releases funds to spend on something else, or to not spend at all, to save, because you have to worry about what you want to consume tomorrow, as well as today. So, I can talk about these sorts of general principles. And I think, as I see China, they have moved in that direction, and that's most dramatic in export markets, because there China has to meet competition. And they've responded to that in ways that make them look very much like any other country. You see. I'm less familiar, though, of the extent to which that has penetrated domestic markets, and the extent to which the citizens of China have benefited from increased contestability in domestic markets. So I'm sorry, this doesn't really Zhenhai specifically address what you said, but what I've tried to do is kind of give you the principles that would it seems to me, apply.
Okay, here's the question from the chat. It's for both Professor Vernon Smith and Professor Cho. Since we talk about ESG, green finance, sustainable finance, I'd like to hear your views on the trend of sustainable finance, the carbon neutrality in the future for the entire world, and are there any medium for trade, for circulation in the entire sustainable finance, sustainable development? Is it carbon? Is it energy? Is it moral? That's a question from the chat. Please.
Well, of course, the environmental study is focused on carbon, and as a primary greenhouse gas, although there certainly are others. In fact, there's much more serious pollutants like methane that is also a contributor to warming. But I'm very sympathetic to the idea of opening some of these issues up to markets where people will, out of their concerns for certain damages that are going on, are willing to put up money to try to reduce those. So far, governments have not done a very good job of getting other governments to agree, you see, on the kind of policies. And even if you do have a trading scheme for carbon, there's the whole problem of actually disciplining this. I mean, if Brazil says that if you give them $3 billion, they won't burn as many forests, how do you know that they wouldn't have done it anyway? You see, how do you actually implement those things? I think that's really difficult, and one of the reasons why the trading idea hasn't gotten anywhere. And markets don't work if people don't know what the property rights are. They don't know the boundaries. If the boundaries leak, you see, then the market is going to fail because it doesn't have a foundation that enables it to succeed. But anyway, I think exploring kind of other and more decentralized approaches to this is much to be merited.
Professor Cho, do you have something to say about sustainable finance?
Would say that the theory of moral sentiment may be a greater intellectual accomplishment than the wealth of nations. At any rate, so that book, plus a lot of subsequent work, remind us that humans are by and large moral to different extent. So for the electric vehicle, just buying an electric vehicle could reflect satisfaction or fulfillment of one's sense of moral responsibility. And similarly, ESG markets, notwithstanding what Vernon said about a kind of incompleteness of financial markets in dealing with bigger issues concerning the environment and sustainability and so on. Nevertheless, electric vehicle as well as ESG investment, they are making a dent, however small, but it's still, I would say, a positive dent in the direction of decentralized, market-based mechanisms that help maybe alleviate the ESG problem. Yeah.
Okay. There is a last one. There is a last question for Professor Vernon Smith and Professor Ding Yifan. Let me read the question. What's your views on the fundamental value of the future of the digital currency?
I don't have a view of its future in terms of what will be realized out of it, but I think these are immensely interesting experiments that should certainly be allowed to go forward. Although these experiments are sort of terrorizing central bankers around the world. But I think explorations of alternative ways of making payment that might be more stable and reliable, because we know that governments tend and easily fall victim to the temptation to manipulate monetary affairs to their own advantage. In particular, central banks want to protect the marketability of government securities, even where those government securities may be producing values or rates of return that people are skeptical of. I mean, you see that in Southern Europe, particularly Greece, but also Italy and Portugal and Spain, where they have difficulty getting investors to buy their debt. Well, that's because it's very, very risky debt. So I think these are I very much support these experiments. Where they're going to come out, I don't know. When I first did experiments in economics, I couldn't have predicted what would have the direction of experimental economics 25 years later. 25 years later, I couldn't predict what it would do in the next 25 years. So I'm not good at forecasting. But I think these people will benefit, I think, from these experiments in new forms of private currency.
Professor Ding, do you want to share some insights?
Okay, that's a very interesting question because this is not an economic question, it's a political question. What is at stake is state sovereignty. So originally, the currency erupted from the private sector. Also, the private banks created money, created currency. While when the state take over the power of issuing currency has become as part of the sovereign power of the state. So with technology development, especially with the development of information technology, some people thought of a digital currency. They created Bitcoin, for example, is considered as a digital currency, as a cryptocurrency, while in an area where more and more central banks are issuing excessive quantity of money. So people are concerned about the prospect of the future value of the sovereign currency. So those privately issued cryptocurrency have become a refugee of wealthy people's stock of wealth. They wanted to make use of these digital currency or these cryptocurrency as a refuge of their wealth. But it flies in the face of state sovereignty. That's why no government in the world, neither in the United States, nor in Europe, nor in China, no government is supporting this kind of privately issued cryptocurrency. While at the same time, the states are considering issuing, China is in advance in these sectors. Every country is trying to issue its sovereign digital currency. And then that will be a sort of substitute to the paper currency. So in currency, we have a transition from paper currency, paper money, to check, so write money, to SIM cards, to bank cards, and then to digital payment, to the electronic payment. And then digital currency, sovereign digital currency will be the next step of the currency. Well, I don't think that a cryptocurrency, privately issued currency, will have a bright future, because all government will work together, will join efforts to kill those private issued currency to some extent. Those big coins has become only the currency of this parallel economy. I mean, the mafia, drug economy, of those things. But they cannot come into the normal circulation of the economy. That's my point.
Okay, thank you. Thank you so much, Professor Ding. Since right now it's almost 12:30, so it's a wrap. Thanks so much, Professor Vernon Smith, Professor Ding Yifan, and Professor ChewSooHong. It's such an eventful talk. Thanks so much, and looking forward to maybe our next meeting or whatever. Thanks so much. That's the event for today. Please please keep an eye on the Hainan Green Finance Research Institute. We're going to have a future international seminars. Thank you so much. That's it.
Okay, goodbye.
And thank you for organizing it.
Thank you.
Thank you.